Hi there, Joe Violetta from Four Core Financial. Today I wanted to talk about 5 mistakes people make when they look at life insurance. Now there's more than 5, but these are 5 that I think are really important that I'd like to kind of address with all of you today. The first mistake a lot of people make is they think it's just for burial. They think it's for old people. So you only want to look at life insurance when you're getting older and need to make sure you pay for your burial. This could be a big mistake because of a number of reasons. One of the biggest reasons is, God forbid, someone dies in a car accident or has a real health issue at a young age and passes away. They could leave a ton of debt behind for the family to have to deal with. The second part of this is health-wise. As you get older, your health could change. And when you get to be into your 60s or 70s, not only could the cost of insurance be expensive, you might not be eligible for the types of plans you'd like to get because your health has declined. So these are 2 big reasons why when you're looking at life insurance, sometimes it's important to plan early and not wait and just consider it what we call burial insurance. The second reason that's a big mistake that we always really see is assuming that since you have coverage through your job, that you don't have to worry about coverage outside of your job. And although I do usually recommend to most people, if they will give you a benefit for life insurance at work, take advantage of that because they're going to cost share that for you while you're employed. Where this could present a problem is if you get laid off or if you decide to change jobs. You've now lost that life insurance. Also, again, if you have a health change and then you want to retire and then you're looking to pick up additional coverage after you retire, that's not a portable plan most of the time. And if it is, you're going to pay a different rate at that time where you might not get any support from the company that you are currently working for. So important to kind of look at, just because you have some coverage, it might be worth looking at getting some secondary coverage individually so that you could have that regardless of what happens to you employment-wise. And again, you'll hear a common theme in these 5 mistakes is if your health history is to change and you have a health scare, whether that be cancer, even if it's removed and you're cancer-free, whether you've had a heart attack, a stroke, these things could impact your health. The third mistake that a lot of people will make, and you'll hear it mentioned, buy term and invest the rest. Get the cheapest insurance you could possibly get. Although that sometimes might be the right approach, is to get a term policy with a larger face amount so that it's more cost appropriate for a younger family to make sure their obligations are paid for. Again, when someone gets older, and I can give you a real life example of it for myself, when I got married 30 years ago, I had a term policy that was a 30-year term policy. It was $26 a month. I was just looking at converting that as it's approaching its 30-year expiration date, and it goes from $26 a month. Next year, it will be $177 a month. The following year, over $300 a month. And the following year over that, $500 a month. So every year, that term policy would increase in premium. So sometimes you might want to have a term policy with some whole life or universal life, even at a younger age, because you'll have some permanent coverage with it. You'll hear that common theme that I mentioned earlier. Well, now at 56 years of age, if my health were to change or decline, I might not be eligible for coverage or eligible at a top tier rate like I was when I was in my mid-20s. So when you hear people say, again, buy term and invest the rest, or whole life or universal life is a scam, you shouldn't be paying a lot of money for life insurance, there's a lot of benefits that you might want to consider. One of them is coverage that you have for your entire life. The second one is that it's a tax-free death benefit. The third one is it does accumulate cash value. Again, I'm not saying that you should definitely do whole life or universal life over term insurance. Biggest part I think you can take away from this segment is be aware of absolutes. If people tell you should never buy term insurance, or you should never buy universal life insurance, or you should never buy whole life insurance, I would discredit that advice and look to speak to someone that is a little more professional, because there is a place for each one of these types of coverage depending on an individual situation. The old saying, one size doesn't fit all. A big mistake we see commonly happen also is not updating your beneficiaries. Things change. As you're younger, you might have life insurance, you might not be married yet. You might have a parent as a beneficiary on something. You might have been married for a number of years and now you're divorced. And, a common joke we always say is sometimes the last person you like to get a hold of your insurance benefits is an ex-wife or an ex-husband. And again, that's not always the situation, mind you, but you might have wanted to change those beneficiaries to be children. Again, you might lose a spouse. Unfortunately, sometimes an adult child might predecease a parent. And if they're on that as a beneficiary, that can end up going through the probate process. And that could take a lot of time for those proceeds to be distributed to the family. So regularly, it's important to kind of take a look at your beneficiaries. I always kind of say do like a spring cleaning. Every year, you should kind of review your insurance and insurance policies. The fifth one is kind of tied into the fourth mistake, is treating it like a once and done, a set it and forget it. You have life insurance, you don't look at it. And this presents some interesting problems as well. Sometimes you might have a term policy and not even know it's expired. We've met people that have insurance policies and didn't realize they were accidental death policies, and they'd only pay out if you died in an accident. Also, your circumstances might have changed. You might need to add additional coverage. Again, it might be an expiring term policy where you have 5 years left on that policy. You might want to evaluate when you should look to either upgrade or potentially downgrade to a lower policy. And why I say downgrade is as you're aging, if you are in developing some wealth and you have retirement accounts and you have other assets potentially, you might not need as much coverage because your obligations might be lower. A good example of that is, again, children. So if your kids are now out of college and on their own and you don't have to worry about supporting them on a day-to-day basis, your need or insurance need might not be as much as it would be if you were younger. Take that into retirement. You might not have that mortgage anymore. You might be debt-free. So again, you might be looking to change what obligations you have in terms of structuring those insurance policies. I hope this helped you today. Please like and share this with your friends. And also, if you aren't subscribing to our YouTube channel, please subscribe to the YouTube channel. You can click below to be able to do that. Joe Violetta, 4 Core Financial. If you need any help with any of these, do not hesitate to reach out to us. Thank you.